Well, good afternoon, everybody, and welcome to our latest mid-year economic outlook, our latest monthly economic outlook presentation. My name is Kenneth Hunter. This is a mid-year economic outlook for 2016, and look forward to being able to present it to you today. This presentation will take about 45 minutes in terms of the presentation itself, and then will be followed by a question and answer session. If you're using the AnyMeeting platform, you have the chat section that allows you to type in your questions if you would like to chat. Then there is some opportunity for notes as well. If you hold on just a second, I'm going to turn down the speaker here. And if you do come in, I am going to set it to mute just so that I can be able to work. But this presentation, of course, will also be made available online as a recording. It is being recorded right now, and so that will be made available to you all very soon. But look forward to having everybody, having everyone with you. If you can hear me from the microphone, please mention on chat right now. Please mention on chat that you can hear me. I just want to make sure that it's working properly. So if somebody will use the chat feature, if not, I'm going to assume that everybody can hear me, but and I'll do what I need to do elsewise to make sure, but I do believe everybody can hear me. But I'm going to go ahead and get started with the presentation, because I want to make sure everybody is on, make sure that we stay on time with this. So mainly what we're going to be doing today is going to be talking about where we are at the 6-month point. Of course, a lot of this information is going to be based off of the initial second quarter reports of economic activity, mostly at of course, a collective federal level by the Bureau of Economic Analysis. There's some other indices that we'll look at and some that are monthly, but a lot of it's going to be quarterly data. We're going to talk a little bit about growing. We've asked a lot of the 5 W's. Why are we growing? I mean, where are we growing? Why does it not feel like it's felt in the past and feel perhaps a little sluggish? Talk a little bit about hiring. And then towards the end, talk about what we should expect. And as I'm closing out, talk a little bit about, we've been in a recovery now since about 2010. If you look at the way that the formal economist, I'm not an actual true economist, but way true educated economists talk, they talk about growth cycles, and they do benchmark when those cycles begin and end. We have been technically in a growth period since the recovery. We've been in a growth period since 2010. So we've been technically in a growth period for the last 6 years on a national level. And if you look at it from a national perspective, the economists are right. Nationally, we have been growing. But the question now, if we've been growing for 6 years, is when is that period of growth going to end? For some of us, that growth really hasn't as much been about growth in terms of growing compared to where we were before the last recession started, as much as it's been about continuing a long recovery or trying to catch up to where we think we should be at this point, all things being equal. And, excuse me, that's going to be a tough question. So it's a matter of where the recovery ends as well as when the growth period will end and we actually start seeing a little bit of broader-based contraction, which we did kind of notice a little bit. We've noticed a little bit so far here in 2016 on the national level. Do also want to take this opportunity to mention that all comments and research and information that I share are my thoughts and my creations and do not reflect those of my employers or of any other organizations I'm associated with. All opinions and comments are my own. Do my best to avoid any direct political commentary or social commentary. If I need to explain anything, I'll explain it and do my best to explain it from as factual or as unbiased a perspective as I can. Let's first look at the economy, and this is looking at GDP. Of course, it is measured quarterly, but these quarterly numbers are based on the annual overall value of GDP, and you can see that at the end of June, we had gotten up to about $16.58 trillion. You can see that little bump, that significant bump that we saw back in 2008, 2009, during that deep recession that we had at that point. You can see that we continue to surpass that. The economy continues to grow. I go all the way back to 1970 because, you could consider these last 45 years, 46 years kind of a its own era economically, kind of the past gold standard economy, an economy heavily influenced by government spending on social programs, military, and other types of spendings, and heavily more interventionist in terms of the federal government's role, whether it be trying to take actions like it did during the last recession to prop up the economy, or even more direct actions to broaden trade. And of course, something that's come up a lot during this political season has been about our involvement with global or continental trade deals, whether it's NAFTA, which of course deals with North America, the GATT, which was of course passed back in the late 1990s, or of course this Trans-Pacific Partnership deal, which has been talked about a lot, particularly as a result of the presidential election and the fact that the TPP will likely be voted on by the Senate, by Congress, next when they get back into session this fall after their August recess. But you can see that's kind of the track. And as you can see, this is real GDP. These are chain dollars. This is based on chain dollars of value in 2009. So this shows overall a continuous growth. We haven't had the chart continues to move upward. But then when we look at it, when you look at it from an annual growth rate, it doesn't look as impressive, particularly in recent years. And that's been because overall we've had, compared to where we were before the 2008 recession, we've continued to be kind of subdued in our overall growth. And that has actually fallen a little bit very recently. The first 2 quarters of this current calendar year, the annual growth rate has been below 2%. And in 2016, for the second quarter, it was at 1.23. Now, that number may get revised up a little bit with the revisions that will take effect at the end of August and at the end of September to that number. But the chances are is that it's not going to reach 2%. And when we look at where we've been historically, what you will notice is that from 1980 to 2007, we were humming along where, even though we would have recessions and dips, and you can see where those dips are, we were humming along where the average economic growth rate overall was around 3%. Since 2010, since we got out of this last deep recession, our growth rate has only been, on average, about 2.1%. Now, you can see that it's really not gotten above, it barely got above 3% on a couple of occasions. But for the most part, it's been below the 3% because that 3% is represented by the yellow-orange line. It's been more, as you can see, closer to what that purple line is, because we can see that there have been some times where it doesn't feel like the economy's grown all that much at all. Sometimes where it looks like it's been growing at a growth rate of 1% or between 1 and 2%. We've had some challenges in the last couple of years due to some issues with winter economic activity, where those first quarter numbers back in 2014 and 2015 did not look good at all. They were followed up by stronger growth later in the year. But right now, what we've seen for the last 2 consecutive quarters is that the growth rate has fallen in both quarters from where it was before. So it does make people a little skittish, but it's important to remember the economy is growing. Now, when we look at gross domestic product, or GDP, there are some elements of it, and I want to talk about this a little bit because this is important. GDP there's a calculation used for GDP, and I feel it's important to look at these different components because they reflect how GDP may feel different to people in different ways. It can also be affected by geography, but we look at GDP in different areas. First of all, there's personal consumption or retail activity or consumer activity. Then you have private investment. That's the business investment that businesses make in themselves, whether it's through starting businesses, expanding businesses, growing businesses, recapitalizing. Then you have trade, looking at exports being a positive, what we are exporting out to the rest of the world. Imports considered a negative with respect to GDP because you are importing from other countries. That does not mean that it's an economic negative. I want to be very clear about that. It only affects, and it's only deducting away from overall gross domestic product. And then government spending. Government spending obviously does play a role. And so I want to show each of these areas independently with respect to their growth rates over the last 45 years to kind of show how they do differ. First, let's look at perhaps 2 that are more easier to understand: personal consumption and private investment. And you can see personal consumption, the one thing you will notice is that very, very rarely has personal consumption actually declined. Now, part of this is because we have continued to grow as a nation on the basis of population. Wages have continued to grow. You also have some minimal effect of inflation, particularly in more recent years. Inflation has not been as significant of a factor overall, though it has affected us in certain areas. There's been a lot of personal consumption as a fact in terms of its role in the economy has continued to grow. Some people see this as negative because they think it's gotten too much, because it encourages people to spend even if it's not necessarily good for them. Others would say that this is an indication of overall health in spite of GDP, because it indicates overall that there is growth potential in the economy. When you look at private investment, naturally it is going to be more volatile. And no better example than when you look at what's happened in the last 10 years, where you look at how overall we were seeing some growth activity. We were seeing some modest growth activity during the 2000s, and then it dropped off considerably, over 25%. Now, this private investment included housing. It included the work that was being done in housing, both in terms of single-family housing as well as in commercial or multifamily housing. And we all know that the housing market took a huge hit back during the recession period. Then you saw that almost immediately that kicked back up. Businesses that did survive the recession had to capitalize. They had to replace equipment. There was some expansion. And it has gone on, but now we're starting to see where that line in the yellow with private investment, you'll notice it was actually in the negative for the first quarter of 2016, and that is a little bit of a concern. But just because one element of overall GDP is in the negative doesn't mean that overall GDP is going to be negative. So that is a good sign, but it's something we have to monitor. Now let's look at imports and exports. And what you can see is that there has been very recently a lot of consistency in both areas. They both seem to be tracking overall kind of in unison with one another, and this goes all the way back to about 2000. And some of this can be tied to the nature of our trade deals. What's happened in a lot of ways is that what we've seen is that while we have continued to see a continued importing of goods, what we are noticing at times some improvement in the export of goods, but we are also noticing a growing exporting of services. And that helps to build up exports to kind of keep them, in terms of their growth and adjustment rates, kind of in line with imports. The biggest import, of course, along with manufactured goods, is energy. And we have seen that reliance upon importing of energy has gone down over the last several years. It's gone up at times as well, but overall, compared to perhaps where we were back in the 80s and 90s, it's actually not as significant of an issue. But as you can see, there's kind of a consistency for the last 15 years or so in those trends. Now, this ties all of them together and adds government. And you can see that government, if you look at the activity over the last 10 years, with the exception of just the last couple of years, overall government, which includes the federal, state, and local governments, overall government as an overall government activity with respect to GDP was actually in a decline for an extended period of time, from about 2010 when the stimulus ended, all the way till about 2014, 2015, when state and local governments were in a better fiscal position to actually be able to start growing their spending. So this area here, if you'll notice, that's probably been one of the longest periods that we've had that, and that is noticeable if you see it. You would have to go almost all the way back. You see a little bit in the mid-90s, but not that significant. That, of course, was in response to the recession and some efforts that were taken to get us out of that recession that was in the early 90s. You kind of have to go all the way back to the 1970s. When was the last time we really saw it at that level? And some people have argued that it's had a negative economic effect and other people haven't. I'm not here to debate that. When we look at some other factors with respect to the economy, one thing that is concerning economists now, and it's been something they've talked about more and more the last couple of months, is about overall productivity. And this is like basically the work output that we are getting per employee. And what you can see is that while productivity has continued to improve, it has begun to plateau some. And in particular, that plateauing has been perhaps over the last year to 2 years. And you can see that productivity has kind of hit a wall, at least for the time being, and it is starting to worry some people because if we want to see the economy to continue to grow, one of the factors that has to contribute to that is overall productivity. And again, when you're looking at productivity, it's about when they're looking at it, it's like real output per hour, like the economic value of a person's output per hour of work across all segments of the economy. And as you can see, it's kind of it's kind of hit a point where something needs to happen to get it to move up, to continue to move up. At the same time, we talked a little bit with respect to exports and imports. You can see that export activity has softened some. Again, when we look at exports, we're looking at both goods and services, and you can see exports were doing very well and were a big contributor overall to our economic recovery and the growth once we hit the recovery mark nationally back around 2010, 2011. You can see that they were doing very well, and now it's kind of trailed off some. And there's not a real big surprise about why that is, and I'll explain that in just a second. When you look at service exports, however, they've remained stable, and while exports are not, while service industry exports aren't necessarily growing recently, that is a sector of the economy that we are maintaining our presence and that we're not seeing a decline. Now, when we look at imports, we also can see that with respect to those imports, you can see that there has been some volatility with respect to imports, but when you take fuel out of the equation, when you take energy out of the equation, the drop-off is not as significant as we think it is. And in fact, import activity, it has grown, but it is actually a little more stable, and it hasn't changed as much as perhaps we would think it has since we kind of hit the full recovery around 2010, 2011. But really what we're talking about here when it comes to imports and exports is the impact of the dollar. And what we've seen, if you look at the blue line, which is of the dollar, what you would find is that the dollar has strengthened significantly since 2014. And when the dollar strengthens in value, it does make the price of exports. It increases the price of our exports. And that is, of course, can be driven by many factors. It can be driven by by how valuable our economy is here, but it can also be driven by how weak other economies are in other parts of the world. So what's happened is that we have seen some challenging moments with respect to some emerging markets in the last couple of years. We've seen some weakness in Europe. We've seen some weakness in Asia. And those have, to some degree, contributed to the strengthening of our dollar here, which does have an effect both with respect to imports and exports. And you can kind of see that as the dollar has grown and strengthened since 2014, you can see how import and export activity have kind of trailed off a little bit. Of course, one of the factors that could also contribute to this is, of course, the Brexit vote that took place in late June. This is, of course, where the people of Great Britain, by referendum, voted to remove themselves from the European Union. And there's a lot of different thoughts about this in terms of what the impact is going to be. As you can see in that graph, that chart to the left, which was prepared by European economists and an economist in Britain, they'll tell you that there is a lot of uncertainty about economic policy right now because of what's happened. And there is. And a lot of it's because some of the people who were involved in pushing for this vote are not going to be part of the government that has to decide what's going to happen. There of course there's been a huge turnover of leadership in Great Britain, new prime minister, new leaders of the various parties in Parliament. There's a lot going on, and the impact has kind of created a lot of uncertainty, and it's entirely possible that what will happen is most people will say that what Brexit does not mean is Britain basically 100% detaching itself from the rest of Europe. What Brexit will mean is it will mean Britain, the British people, not wanting to be part of what you could say, a continental government. But that from an economic policy perspective, that there will still continue to be strong relationships with respect to trade, with respect to other elements of economic policy, because there have been for a very long period of time. When I look at it from a historical perspective, I look at it that the common market, which goes all the way back like to the 1950s and 1960s, to the efforts to try to revitalize Europe's economy after World War II, Britain has been a strong participant in that for a very long period of time. The the more modern European Union, this continental government, which does have a role in policy with respect to immigration and with respect to environmental policies and personal policies that affect the lives of every citizen in Britain, that is something that does have to be looked at carefully. And it's not just British people that are looking at it, it's people across the world. Now, there will be some effect to that, but we'll just have to see. But one of the things that has been noticed is that what it is doing is that if it does affect and does lead to some economic challenges in Great Britain, what it does do is that it encourages, with our stronger U.S. dollar, it could potentially encourage more import-type activity, such as increased travel to Europe by Americans or increased investment in Europe by Americans because of the weaker value of their currency in Europe. But we're not for sure about that just yet. Overall, the stock market continues to improve. This is the S&P, and as you can see, they continue to hit growths. That little blip, that last little blip right around here is the Brexit blip, as you can see right there. And as you can see, they fully recovered from that and are back now, continuing to, as the S&P continues to reach overall all-time highs. Overall, sectors are looking pretty good. The S&P for the year has grown about 6%. And you can see in several sectors, the S&P stocks are improving. Perhaps the one that has taken the one negative so far for 2016 has been financial services. And that's been because there are some concerns in the banking sector and in insurance. When you look at over the 12-month period, areas like energy have been able to recover a lot of losses they suffered last fall, as well as also in healthcare. You can see that healthcare so far this year has been able to recover some of the losses that it suffered last fall as well. But overall, most stocks look good. Depending on your view about stocks and how they relate to the economy, you may have differing opinions about what that really means. With respect to the housing market, talk a little bit about this. Housing prices are up. Demand for housing is up. What I would say, though, is that it's really being driven by what's happening in desirable markets. Again, the key to real estate is location, and we are seeing that the activity in major cities is driving overall housing market activity. So, for example, if nationwide prices, if we looked at nationwide price indices and they said it was going up about 5.7, and you look at the Case-Shiller, which looks at the 20 largest markets in the United States, and it says that those markets are growing by 7%, that, if you were to average out, that would probably mean that most everybody else is below, is maybe perhaps below 5%, and that's at a 3-year annual rate of growth. Obviously we're starting to see where we're starting to get back up to those pre-2008 recession highs. Obviously there's a lot of concern about what that means in the market overall. One of the things that is concerning is that while we have continued to see improvement in the housing market, mortgages continue to be very low. So despite the fact that the overall market, the prices are increasing, which indicates that there is a demand out there, not as big of a demand as there was before the recession, but there is still a demand out there, you can see that overall mortgage rates really, to kind of help feed that demand, mortgage rates remain low, and in fact they've actually gone down a little. They went down below 4%. They started the year at 4%, and they've gone now down to where the most recent reading was below 3.5%. Part of this, of course, is the issue of what the Fed is doing with interest rates. The Fed has not raised interest rates above 0.25%, and some people are saying, hey, at some point they're going to have to take action, and that's going to lead to mortgage rates going up, maybe to 4.5%, 5%, maybe even higher. And if that does happen, the question is going to be, well, what's going to happen to the real estate market when that occurs? There is going to be something that's going to happen. We don't know what it'll be just yet. Now time to talk about an area that I was actually having a conversation with someone yesterday about this, and it is an important area, and that's retail activity. And there are different elements of retail, and that's why I'm going to talk about this. I'm going to start at the broad, and I'm going to kind of segment it a little bit. When you look at overall retail activity, what you will see is that in the last year, retail sales of all retail in real dollars, and I guess in what you would call chain dollars, adjusted for inflation, has gone up about 1.6%. The annual average over the last 3 years has been about 2.1%. Now, that's not phenomenal growth, but it's steady growth. It's a good sign. It's a sign that the market that the retail sales continue to grow, and they should, because overall you have a growing population. Nationally, our population continues to grow. There is, of course, there continues to be good demand. It's not a bad sign to see retail activity go down. It is a good sign overall, looking at it over the last 3 years. Now, we need to ask ourselves, so where is the growth? Because if we were to just say that retail is growing 2.1%, then you would be saying, well, why is it that we hear this negative news from this group and negative news from that group? And the reason is, not all retail is seeing the same thing, and in fact, there's significant disparities in what different sectors of the retail industry are experiencing. First thing you'll notice in the last 3 years, and these are annual averages over the last 3 years, you look at non-store retailers, and this includes e-commerce. There's some others in there as well, but this includes e-commerce. They are growing at an annual rate of 10.3%. So non-brick and mortar, non-physical location retailers are seeing pretty strong growth right now. Restaurants and bars, food service industry is also seeing growth. I was not able to segment it in terms of the kind of activity, but when you look at it, when you look at some of the industry publications, what you will find is that while overall restaurants and bars are seeing growth, that growth is not being evenly distributed. A lot of that growth is going to certain concepts in certain sectors, from the fast casual places like Chipotle, all the way to more focus on local and authentic cuisine, different kinds of restaurants, different types of taste, appealing to different audiences. So not all retailers, not all restaurants. In fact, there was a restaurant chain today that's responsible for restaurants like Fox and Hound and Bailey's Tap Room that or Bailey's Sports Pub that actually declared bankruptcy. So there are some restaurant chains out there that are struggling. Then you look at department stores, and of course these are the bellwether of retail for a long time. These, of course, we've all been to them. They're actually seeing their sales decline at an annual rate of 3%, an annual average of 3% over the last 3 years. And of course, then that leads to things like, and then at the same time that goes on, you can see that if department stores are going down and non-physical locations are going up, then what that means obviously is that e-commerce is driving growth, and as you can see, is that it is. It continues to see its share of overall growth increase, and it's probably likely that within the next year or two, you're going to see that go up to perhaps 10%. What I would also say is that there's a newer component of this, and it's not really able to be shown in the data, but it's brick and mortar businesses that are receiving the benefits of e-commerce to help their business. And for example, in restaurants that have gone and established mobile applications for ordering, so that you can order online in advance and pick it up at the location. From the standpoint of the business, they're still getting the business at the store, but the experience for the customer has changed. My wife is real big about this. I talked to someone from a restaurant who's just implemented this in the last couple of months. Even though they've had some things that they've had to work out, they've been really excited about it. And I would say if you took that, in the next couple of years, if you took that and then you added the more traditional e-commerce retail, online businesses like Amazon and Overstock, and you put those together, I think that you will see that it could be potentially 15% within the next couple of years, if not more. But again, it could not be. Because in reality, there's a third part to it, and it's the fact that traditional retail businesses, those who are more department store oriented or that are more physical oriented, have to change their business. And the biggest one to come out was today with Macy's. Macy's announced today that over the course of this year and next year, they're going to be closing about 15% or over 100 of their department store locations. This, of course, was met immediately by praise from the market. Their stock price is up. These quotes here are from their press release from this morning. And really, if you were to read it, and if you look, I highlighted the area or did a color change on what's most important. While still maintaining a significant bricks and mortar presence in 49 of the top 50 markets, Macy's will operate fewer stores and concentrate its financial resources and talents on our better performing locations. Stores will remain critical customer touch points along with online shopping and mobile apps as omni-channel or, of course, diversified retailing continues to evolve. In other words, companies like Macy's, which it's almost like now, I went to a Macy's a couple of weeks ago when I was back home in Tennessee, and it's almost like every time I go to Macy's, there's a lot of stuff always on sale. There's always stuff on sale. The model of those type of retailers, of that type of retail environment, is not going to work as broad as it used to be. And what companies like Macy's are going to do, Macy's, of course, being the biggest retailer, one of the biggest department stores in the United States, is they are going to say, okay, there are certain markets where department stores will make sense. Probably in better markets where there's more purchasing power, where the malls are in better condition, where their stores are perhaps newer. There are certain places where there's still going to be a physical retail presence. But in a lot of other places, they're not going to say, we're not leaving, we're just getting rid of the physical location because we know people are going to go online. And there's other retailers that are going to be looking at this. And as they move out of having the physical presence in markets, they're not going to say that they're leaving. What they're going to say is, we're just leaving away from not having the store. Instead, what we're going to have is, we're still going to connect with our customers, the customers who we've been connecting with online. Because if they're subscribed to our text service for coupons, or they're using our online wedding registry, or whatever the case may be, the reality is we still have a chance to build a relationship with them as an online retailer. And the reality is that more and more people are becoming more and more accepting or preferring to do their shopping online for all types of various reasons. Now we go from that discussion, now looking at employment. Overall employment activity continues to grow. Year to date so far, we've had a total 1% increase in non-farm payrolls nationwide, and over the past year it's been about 1.7%. And as you can see, that growth has been pretty consistent since we kind of started getting out of the recovery around 2011. Some people would say this is not sufficient enough to sustain overall growth of the real labor force, not the labor force that's calculated with the participation rate. And I would say, when I show you something later, that they're right. But we are seeing that there is workforce growth. We are now about, as you can see, we were about a little over 138 million jobs when the recession started, and now we're right over 144 million. So we've grown by about 6 million jobs in the last 8 years. That's some people would say that it needs to be more. I'm not going to say that it shouldn't be, but that's where we are at this point. Another concern a lot of people have is where those jobs are being grown. Not necessarily that it's bad that they're growing in those areas, but does the labor market, particularly in certain parts of the country, match up to where the growth is? And as you can see, this is year-to-year change, and again, I was around 1.7. This says 1.8. But you can see in the 5th District, for those of you who know, this is the Richmond District of the Federal Reserve, so this is basically the Mid-Atlantic, the Carolinas, Maryland, Virginia, Delaware, and the District of Columbia. And what you see, and also West Virginia, I'm sorry. What you see there is that there has been some growth in the construction industry. There's actually been some higher increase. But when you look at areas like manufacturing, which has been the primary source of employment for a lot of communities across the country, especially of those in rural areas or that are located away from major cities. I mean, a lot of manufacturing development over the last 50 years and 75 years has been in small towns all across the country. You can see that area is still not necessarily seeing a lot of growth activity. There is manufacturing growth, but it's not from the standpoint of employment. The manufacturing growth is more in terms of productivity due to the use of automation. So it is something that we have to keep in mind. While at the same time, other sectors like information, financial services, business and professional services, and healthcare continue to see growth and are really the sectors of the job market that are growing. But the real challenge is, does the population of a given location or does the business climate of a given location really adapt itself well to those sectors? And if it doesn't, then they're not seeing the growth. And I think those who live in those areas will tell you exactly that. At the same time, the other good news with respect to the job market is there's lots of jobs available. Right now, openings are still remain over 5.5 million, almost 5.6 million openings nationwide. Again, that's even significantly higher than where we were before the recession. Layoff and termination and discharges is not that terribly significant right now. They remain at a monthly level of less than 1.8 million, more around 1.7 million, and have kind of just stayed there. I mean, it's that doesn't mean that layoffs aren't going to have negative effects on particular localities, but it's not a signifier of a national trend. Businesses are going to change. Some companies are going to consolidate and close. Others are going to shed jobs as part of improving efficiencies. But it does not appear that there's any overall industry sector or nationwide situation that is leading to massive layoffs in the overall job market. The other thing we're starting to see also is that turnover is picking up, and this can have an effect on productivity. As you can see, we're back up to pre-recession levels on the number of people who quit jobs on a monthly basis. And, of course, that does have a fact that does contribute to increased openings. There's, of course, a lot of people who will tell you different factors for this. Some is due to, of course, issues within the companies themselves, lack of proper management, lack of proper training, lack of proper motivation. Others would say it's because in certain skill sets, employees have the ability to find jobs and are not as pressured to have to keep jobs that they're not happy with. Of course, what turnover does do is that turnover does contribute to increasing labor costs, because obviously one of the first things that employers will do to try to reduce turnover, to try to retain workers, is that, of course, they will be forced to have to raise wages. But that's not entirely true, because something else that's been going on has to do with hiring itself. And if you look at it, since about mid-2014 or it's the kind of fall of 2014, there was a spike earlier this year, late 2015, but you kind of see where we are right now. We're below 5.2 million hires a month. We're kind of where we were in 2014, and we're still not where we were. We're not where we're kind of in a stuck point. It's kind of plateaued, and this can be a concern, because obviously if companies have vacancies they cannot fill and need to fill, then that is going to directly have another effect on productivity. And again, productivity is a pretty significant driver of overall GDP. So that is a concern, because, overall, when you look at the percentage of our total population that is working, we're still below 60%. After the recession, we dropped down to around 58.5%. That's the lowest level we were. The last time we were at a level that low was during the 82-83 recession, which was a heavy manufacturing recession. After that, we went up significantly, and by 2000, we were around 64.5%. Now, some of this has to do, of course, with the retiring baby boomer population, but even if you were to look at an even smaller subsets, like the prime age population, the 25 to 54 age group, you would see that their employment to population ratios are at levels that have not been seen in over 30 years. So the reality is that level is very low. So if people aren't working, and again, take that chart I just showed you about employment population, you look at GDP, and you start and really looking at those averages, that impact that overall participation and productivity is having on potentially keeping GDP low or vice is significant. And so the question is, why is this happening? Why is it that there's lower participation and as a result creating lower productivity, which is having I won't say negative, but is putting a downward pressure on overall GDP. At the same time, labor costs continue to rise. You can see that in the last year, looking at unit labor costs, those have gone up by 2%, 3-year annual average of growth of about 1.8%. Of course, you would hope that a good portion of that is tied to wages, because that's really how employees view what they're benefiting from the standpoint of cost. But as you see here, wage growth, even though it was consistent with overall labor cost this year, it's actually significantly below it in the 3-year average. And again, some of that, for those of you who deal with your employers' health insurance plans, or who are working with any other types of fringe benefits that you offer, or other areas of cost that are tied to labor, you know that there are other things that are driving overall cost of labor besides the pressure for wage increases. And as you can see, when you look at those, when you look at where we are now at around $346 a week average for weekly earnings, weekly real earnings. These are earnings adjusted for inflation. You can see that we've just now, in the latter part of 2015, and early 2016, have just now restored those earnings, those weekly earnings, to the level that they were during the recession. So I mean, that's a huge deal. That's the reason why people will tell you that they have felt declining wages for a long period of time. And I would also say that if we were to probably sector that out, separate it by employment sector, you would see several sectors where that number would still be below the pre-recession point, because of just the simple fact that there have been several sectors where wages haven't gone up, and in fact wages have gone down. So we look at it in the aggregate of the total, it looks like we've caught up, but in reality, just catching up 8, 9, 10 years from where the previous high point was is not necessarily an indication of progress. It's more of an indication, okay, where do we go from here? And this is what's driving some of perhaps the more extreme viewpoints with respect to this element, to the element of wages for employees, those people who are pushing for everything from the $15 an hour movement to those who are even pushing for even more extreme actions to try to basically force through policy and government action to increase wages. Now we kind of come to the point where it's time for us to look at, well, where do we go from here? What does 2016 look like? Well, the good news is that for overall, it looks like 2016 will be a good year. The leading economic indicators, where we look at for the next 6 months, have continued to improve. They continue to reach the high levels that we saw back prior to the recession. They're plateauing a little bit, but they're not bad. This is also the case in most countries. They look good, particularly in Asia, some in South America. Europe does not. As you can see, France is down, Spain, UK are down. But we are seeing where indicators are moving forward, and the coincident indicators, what's going on right now, the indicators of activity going on, of economic activity right now, also continue to be moving in a positive direction. Looking at North Carolina, for those of you who reside here in North Carolina, this study is prepared monthly by Dr. Michael Walden at North Carolina State University. And he's talked about how overall the indicator really hasn't changed much since late last year. But when you look at it in comparison to where it was last year, it's gone up over 3% overall compared to the same point last year. And it's an indication that overall economic performance within the state of North Carolina, and for states that are similar to North Carolina, I would say the same thing, especially those that are in the southeast, or at least I would suggest it. I wouldn't put money on it, but I would suggest it. It's an indication that economic activity in those states that are very similar, that are in the South or in the Mid-Atlantic, that there is a steady trend with respect to economic activity. Doesn't mean that everybody's going to grow, particularly in North Carolina, where there's going to be significant local differences in terms of job growth and economic growth due to how each local area fares with the overall economic picture, the sectors that they're more focused on compared to where the national growth is centralized. But this does overall show a positive sign for the state of North Carolina. Then we look at small businesses, and the NFIB report. If there was going to be a pessimistic report over the last several years, it continues to be the NFIB. And a lot of it is because small business owners have had some of the biggest challenges in recent time. They're the ones who've really had to figure out how to adapt to this changing economic environment. And as you can see, they're kind of a mixed bag. Their optimism scores have improved a little bit, but they're below 100. They've been below 100 since late 2014. And that's been because that while there has been some improvement, they're just not happy. And a lot of it has to do with a lot of uncertainty due to policy, due to economic conditions, just a lot of uncertainty. And a lot of small business owners just don't know really where they want to go. And, of course, this is a big challenge because most people from the standpoint of how they view what's going on in the economy, a lot of it is driven by what they're seeing happen in the business sector of their community. Do they see businesses opening, or do they see businesses closing? Do they see businesses that have help wanted signs out, or do they see businesses where they hear about their friends who've lost their job because, well, there's just no work to be had, or the company couldn't afford to keep them? So there's a lot that is unknown at this point. You would like to see that there would be that the net of activity of people, of small businesses looking to increase employment, would be higher than a net plus 12%. You would hope that it would be significantly higher. There are companies that have a lot of current job openings, but when you look at that bottom line, 21% actually think there's a net 21% difference of the 21% more people think that the earnings for their business are going to go down rather than up in the coming 3 to 6 months. So, particularly when it comes to hiring, which is of course a major indicator, you can see here that the positive is around 25% in terms of can the small businesses hire who they need. Then when you look at small businesses planning to hire, you can see that really only about 10% more businesses plan to hire than plan to actually cut back on their workforces. That's not necessarily a good sign. Now, to kind of see overall with respect to the economy, this data is provided by this is actually from the Federal Reserve Board. When their economists, when their board of governors meet, they kind of put this little report together, and it is their evaluations. And what you can see is they're back in December. This was the most recent time this was done, was back in the summer. You can see I really wanted to focus on change in real GDP. And you can see that they're kind of not expecting much change. They've kind of cut back a little bit on what their indicator was, on what their projection is going to be for this year, and then going into the future, it's kind of about the same. And they're looking basically around the 2% mark each year. That's not really, I think, where a lot of people want to be. Looking down at the bottom one, where you look at the federal funds rate, they're not anticipating it going above 1% this year, probably getting around 2% next year and going to 3% in 2018. And of course, the question will be, well, does it need to go even higher? Some people would say it needs to go higher than 3%, but the reality is that they're thinking that they can try to kick it up about 1% per year from where it was last year. But we'll just have to see where we are. Look when we kind of get towards, because the first 2 quarters are not positive indicators of being able to raise interest rates, even though eventually interest rates are going to need to be raised. To finish up, a couple of more narrative observations. First of all, with respect to North Carolina, from Dr. Walden again, you can see he is anticipating continued economic growth over the next 2 years, about 86,000 jobs for the state of North Carolina in 2016, about 90,000 in 2017. This is a modest number. It's been consistent with what we've seen in the last couple of years. However, as you can see, he also says growth in the state will be uneven. He does not anticipate where the growth is going to broaden its presence across the state. And this is kind of consistent with what I've seen a lot of economists say. What I've noticed is that the economists out there know that there's going to be another recession, but they just don't know when it's going to be. And what they would rather do is perhaps be guarded in their optimism or guarded in their assessments, so that if things turn out better, they can say, hey, that's great, it's wonderful. What they don't want to do is be expecting things to get better and then things get worse. They want to be, they're going to be cautious. They don't want to be caught off guard like they were back in 2007, 2008. Small businesses, that last one down there at the bottom, they still remain pessimistic, and a lot of it just has to do with a lot of uncertainty, typically with policy and how other broader issues are going to affect the small business community. And finally, just to kind of focus on a couple of trends, up here you've got the millennials on their tablets. I think really we're going to start seeing, I think, more and more separation from a market, from an economic standpoint with respect to businesses and how, if they are able to connect with this audience, with the millennials, then I think they've got a better chance for growth. Not everybody agrees with that. There are some who say, well, it's really the millennials aren't the key, it's more the elder population. But what I'm noticing is that more elder people seem to be more interested in kind of adapting themselves to use of technology. We have to kind of look at with what's happened in the past couple of weeks with Pokemon Go from a standpoint of people playing it and getting interested in it. Is this an indication that the technology or that the concept that's really behind it, the augmented reality concept, is that really going to be a factor from the standpoint of a trend that more and more people are going to go to? Are they going to want? Does this mean that businesses are going to have to create a more interactive experience with their customers, particularly online? The holidays are coming up, of course, and we'll just have to see how that affects the economy. Are we going to see, is there a possibility that a couple of years from now that the holidays are not going to have a significant impact on retail activity? It's entirely possible. I would not say so right now, but I'm not going to say that it won't ever happen. And then last and certainly not least, we have the election that nobody's terribly thrilled about, but that everybody's going to participate in and comment on anyway, between Donald Trump and Hillary Clinton. And so far, what I have noticed is that there is no real consensus in the business community, the economic community, the investor community regarding any feelings about whether or not either of these candidates are going to be a benefit for this country. There really has not been any consistent indication that that the people who are responsible for growing it from the investment side and the business development side of our economy are terribly thrilled with either candidate. Not to say that one of them can't come up with something that will change those lines and kind of create a consensus, but for right now it doesn't appear that that consensus exists, and that could affect overall feelings about the economy. And the one thing that I will point out is a lot of times what we see when we start seeing the trend downward is that it's not as much driven by actual indicators, but a lot of times it can be driven by the lack of optimism. At the same time, growth can be driven by feelings of optimism. So, I think back to when I was 15 years old, when Bill Clinton became president in 1992. During the election, we were in a brief period of economic decline, a brief recession. The optimism started picking up towards like mid-fall, before Clinton got elected. And I can remember my dad saying, the best thing he could do for the economy once he got elected was to actually not do anything and to stay out of it, because in reality the optimism could carry the economy into growth. Not saying whether it did or not, but the fact is that is something for us to look at going forward. And so with that, I've completed my comments and presentation. If you are interested, my next presentation is going to be on October 13th at 1 p.m. Eastern, and it'll be done through the same channel, through the AnyMeeting platform. Not going to do one in September because there's just not a lot of data that's going to come out. The next presentation, though, in October, we'll try to do a little bit better job of focusing on some particular sectors. But at this time, if you want to use the chat feature, I'll be happy to take any questions you may have. Just go ahead and write them into the chat feature if you're there. If not, there are two people that I saw that are on. Try to see if I can unmute. But if anybody had any questions, I'll be happy to take them. If anybody has any questions. Well, seeing that there are not any questions, I'm going to go ahead and end our presentation. Again, if you are interested, our next presentation is going to be on Thursday, October 13th. And I thank everybody for their participation, and look forward and hope that you either enjoyed this webinar or enjoyed the replay, and look forward to talking to you soon. Take care and have a good rest of the day.